Okay, let's talk about this, what you see in front of you. This is the S&P 500 over the past 3 months. Specifically, we're going to talk about this time period at the end of September through all this volatility we've had all the way up until even today, December 10th. But I'm going to do some numbers through Friday just because that's the most final numbers I have. So what I did is I just simply took those S&P numbers from that graph I just showed you and built it into a spreadsheet. You can see the end of September through Friday. And then I took one of our portfolios to measure the difference, what's going on. And what I want to talk about in this video is the difference between in real time. In real time, you can see how tactical works. So on this side, this is going to be buy and hold or modern portfolio theory, which is basically, yes, you may have a diversified portfolio. You have large cap growth, small cap growth, large cap value, international, high yield, mid cap, and a bunch of smattering of bonds. Yes, you are diversified, but your overall portfolio, you basically might do some rebalancing and so forth, but you're basically going to buy this and hold it for the long term. And when things get difficult, you know, your broker just kind of pats you on the head and says, don't worry, it'll all work out. On the other side is tactical, and I've done a bunch of videos on the differences, but I thought it would be interesting to look at this real time. So here we have basically the end of September, early October. So through the month of October, the market sold off 7.45%. Okay. Now, every manager on the planet, including our tactical managers, went down the same. Why? Well, draw a little graph here. As you're coming through the summer, and market's generally basically going up, and then it kind of flattens a little bit in September, and then there's this sell-off, what we just talked about. There's a little bit of a rebound, and then a further sell-off. Okay, so if the market's doing this overall trend up, and then suddenly sells off 7%, unless a manager has a crystal ball, which they don't, they're going to experience the same thing that the market is doing. Okay. So then what I want you to look at is the month of November, the market bounced back positive. It was up 1.78. But what did our manager, the tactical? It was only up 0.72. Why the difference? Why the 1% difference? And this is the beginning of understanding the differences between tactical and versus buy and hold. A tactical manager, as you are approaching this area, so this time bracket, right? So from here to here, this bracket right here, they are doing a bunch of measuring, because what are they trying to determine? They're trying to determine if this is just a temporary sell-off because people were taking profits, or there was some small issue going on and it just needed to be flushed out, and the market's going to turn around and resume its upward trend. Or are they looking at this time period right here to determine, is this about to be the bottom to drop out, and then we have another 2008 where you lose over half your money, right? And this is the difference between the tactical and the modern portfolio theory, the buy and hold, is what happens right here. So the market rebounded a little bit in November, went up 1.78. Our tactical managers were only up 0.72. So why the 1% difference? Well, because the tactical managers can do things that the buy and hold modern portfolio theory people either won't or can't. If you're in mutual funds over here, which is basically what everybody's 401ks are, you have a mandate. 80 to 90% of your assets here must be fully invested at all time. You can't move the money unless you literally call your broker up and say, get me out, which is just never a good idea, right? Because your timing of getting out is never right, and then when do you get back in? The tactical managers, because of their algorithms and all the strategies that they have tested and implemented, a tactical manager can do what? They can go to cash. They can use an alternate investment, meaning if they are a large cap growth manager by definition, but it behooves them to move to treasuries or high yield just because that's where the returns are. They can do that. And the third is they can go inverse. But let's focus on this first one, cash. So during this period right here, as the market's going down, right, the tactical managers are doing what? They're going to a little bit of cash because they're always looking out for what's down below. So when the market does this little bit of rebound in that month, they are going to lag. They're not going to have the pure rebound. Why? Because they have moved money to cash. But then look what happens the first week of December, what we just experienced here the last week. The market sold off another 4.82%. What did our managers? They're down 1.47. A 3.5% difference. Why? Because they continue to go to cash, because they're continuing to measure this discrepancy in what's going on in the market. So they're continuing to move to cash because they don't know what's below this. Now, we don't know where we stand here. We don't know if everything going on with China and some of the minor noise about the Fed is going to get cleared up and then the market will bounce back and head this way. But if there's a contagion, meaning everything going on with China, or maybe it's something over in Europe, Deutsche Bank, for example, something grabs a hold of this weakness in the market and really drives it down. What we saw in 2008 is weakness in the overall housing market. Really, it's probably weakness is a mild way of putting it, but the contagion was big firms, Bear Stearns, and then ultimately Shearson going bankrupt, and that contagion just caused the major sell-off, right? We don't know where we're at. Now, my personal opinion is that everything going on with China and the Fed, it's going to be cleared up, and we are going to be back on this path right here. But you just never know. And because you just never know, your money manager needs to be adhering to their algorithms and strategies and making sure they don't get caught off guard. And just so you know, this kind of sell-off right here, we're down from our high, a little over 10%. I don't know why the 10% is a magic number. I know by definition that a 10% or greater is considered a correction, right? I don't know if we are in a correction territory. I mean, our economy is so dang strong. I think this is really more political, to be honest. I think that there's just some posturing and a lot of behind the scenes gerrymandering going on that I believe will actually be worked out. But the reason I point out the 10% is most tactical managers have a 10% breach where they just simply will not let a portfolio go down more than 10%. And you can see here, their tactics have already slowed this down, and they're only down 8% from this sell-off. And just know that if this market continued down, that you wouldn't see much more erosion here, that the tactical managers would be going heavier into cash, start using alternate investments. And if this really is a turn south, if the market really does turn south, not all, but a lot of the managers will execute inverse trades, meaning as the market's going down, you're actually making money. So no, I do not think this is a repeat of a 2008 scenario. I think that we just have some volatility to work out, but I thought it would be helpful to go through some of the mechanics so you can tell the difference between tactical, why we use this, and I think this is a great illustration for you to understand that the secret here, I'll tell you a secret, okay? If this is the markets over the long haul, right? And if we say this is a 20, 30 year period of time, avoiding these is the secret to accumulating real wealth, right? You can't make money purely by just skipping off the top of this. I mean, that's unrealistic. But if you can mitigate these greater than 10% sell-offs, then that's how you create true long-term wealth which is what we're all trying to accomplish. Okay, hope this video was helpful. I thought the timing was particularly good, so thanks for watching.